Good morning, everybody. Welcome to this quarterly presentation from TIPS. The first presentation is going to be on the Real Economy Bulletin, followed by FDI Tracker as per the program. Colleagues, I think in the interest of time and to perhaps make it easier for the presenters, can we have an arrangement that please keep your questions until the presenter has completed the presentation. Then we'll have a short discussion on that. So with that, Lesego, over to you. Thank you.
Thank you, Fanie, for the welcome, and thank you to everyone online and to the people in the room for attending today's session. So my name is Lesego. I hope everyone can hear me. And today I'll be presenting on the Real Economy Bulletin for the second quarter of 2023. So for some of the colleagues who might be new, the REB is a quarterly review of trends, developments, as well as data in South Africa's real economy. It includes a comprehensive analysis of the main manufacturing industries, as well as associated key data. So in this presentation today, I'll be presenting on the following trends, including GDP, employment, international trade, investment and profitability, as well as FDI. For this edition, we also have 3 briefing notes. The first briefing note being on internal migration and industrial policy. The second briefing note is on the TIPS report on localization. And then the third briefing note is on the Accord program. So to get into the presentation, the first trend that we look at is GDP growth. And so in the first graph, what we see for quarterly change in GDP is that GDP grew by 0.6% in the second quarter of 2023. And this was actually a slight improvement compared to the previous quarter. And this actually maintains a return to pre-pandemic levels after the large drop that we saw in the second quarter of 2020. And also the growth was primarily driven by a 5% increase in investment by the private sector, as well as by state-owned enterprises. And we saw increase in investment in off-grid solutions, including renewable energy technologies. But in contrast, when we look at household consumption, for example, we see that it fell by 0.3%, while government consumption rose to 1.7%. And this was the fastest increase since 2015. So the second graph shows quarterly GDP. And what we see in this graph is that there has been growth in the second quarter of 2023, as I've highlighted, and this has improved slightly compared to the previous quarter, which was quarter 1 of 2023. And the slight improvement occurred despite continued load shedding, which suggests that at least the larger enterprises and companies have actually adapted to the new realities of living with load shedding. So we also looked at GDP trends by sector. So this shows growth in value added by sector. And this data is for the year to second quarter of 2023. And what we're seeing in this graph is we're seeing manufacturing showing the second fastest growth in value add. And also construction experienced a recovery. And this was followed by years of stagnation. And then for mining, we see that it recovered after a decline in the second quarter of 2022. And then finally, when we look at retail value add, we see that it shrank, and this was in line with the fall in household consumption. So next, it's manufacturing sales and manufacturing sales by industry. So the first graph shows the monthly manufacturing sales. And what we see in this graph is that over an 18-month period, manufacturing sales have actually leveled out in constant rand terms, and this is actually averaging just above pre-pandemic levels. And when we look at manufacturing sales again, we see that they actually, however, declined through the period of quarter 2 of 2023. And then on this graph, we have quarter sales by manufacturing industry from 2020 to 2023. And and then what we're seeing here is that sales increased for food and machinery, for example, when we look at year-on-year growth. However, we also see that sales fell marginally for metals and for the chemicals value chain. So another important trend that we look at is employment. And in the slide, I'm just going to take you through some of the employment highlights. And then in the next few slides, I'll be taking you through some of the employment data in detail. So when we look at employment, we see that employment actually climbed from the second quarter of 2022 to the second quarter of 2023. And this saw an addition of 780,000 jobs. So when we look at where these jobs are, we see that almost all of the net job gains were in the formal sector, with the strongest showing for retail and elementary positions. So manufacturing also kept pace with overall jobs growth, but the picture was mixed at the industry level. When we looked at the subsector level, we see that metals, clothing, and autos saw gains in employment, while net job losses emerged in chemicals as well as machinery. And when we look at food processing, we will see that employment remained mostly flat. So to get into some of the employment trends and data, we looked at employment by occupation. This looks at employment by main occupation. And what we're seeing here is that retail plus the elementary positions actually grew rapidly when we see year-on-year growth, and it actually surpassed the pre-pandemic levels. And then for professional jobs, which include your managers as well as some of the technicians, we see that it mostly remained flat, and there was an edge up compared to the previous quarter. For domestic and informal workers, we see that it's actually flattened out, and this is mostly a result of the formal sector beginning to generate more jobs. We also look at employment by sector. So this is employment in agriculture, in manufacturing, utilities, as well as construction. And this is compared to the rest of the economy. And we look at the period from 2008 to the second quarter of 2023. And from this graph, what we're seeing is that manufacturing employment rose slightly when we look at year-on-year growth. And this was by around 50,000 jobs, while agriculture, which is shown here at the bottom, remained flat. But for manufacturing, when we look at quarter-on-quarter growth, we actually see that there was a decline in manufacturing in this quarter compared to the previous quarter. And we're also seeing that with that data, it's not seasonally adjusted. When we look at construction, in contrast, we see that construction actually showed significant growth, and it actually generated 120,000 new jobs. Employment by industry. So this shows the subsector level for manufacturing industry. So we looked at the second quarter of 2020 all the way to the second quarter of 2023. And so what we're seeing here is that employment expanded quite significantly when we look at year-on-year growth, and this was for clothing, as well as for metal products. And when we're looking at the largest employer in the manufacturing subsector, which is food processing, we saw that food processing employment has remained flat. And then for chemicals value chain, machinery, as well as other smaller industries such as glass, and non-metallic minerals, we see that employment declined in those subsectors. And then next, we look at international trade. So for international trade, we look at the exports, the imports, and the balance of trade. And this is in billions of constant rand. So for the second quarter of 2023, we see that international trade recorded a surplus of 10 billion. And this was up from a deficit of 5.1 billion in the first quarter of 2023. And what we're also seeing is that after 2 years of very high trade surpluses from the third quarter of 2020 to the second quarter of 2023, the balance of trade is returning more to normal trends. So international trade, looking at exports and imports, I think my colleagues, Nokwanda and Wendy, will go into this in a lot more detail. But then for the REB and for this presentation, what we're seeing when we look at exports is that mining exports fell 20% in the year to the second quarter of 2023, and they dropped from 284 billion to 228 billion. And the main reason for this was the drop in core prices at the end of 2022. And when we look at mining exports, we actually see that they actually remained far above their pre-pandemic levels. And for agriculture and manufacturing exports, they actually continue to increase. For agriculture exports, they increased by 11%, and then we saw an increase of 7% for manufacturing exports. And then for imports, manufacturing imports grew rapidly after a decline during the pandemic, and imports actually reached a high point of 387 billion. And this was an increase of 49 billion from the second quarter of 2022. And then also lastly for imports, the imports of extractive products, and this is mostly petroleum, we see a drop of 20 billion in the year to the second quarter of 2023, and this was largely resulted from falling global prices. And then investment and profitability. So this looks at investment by type of investor, as well as the investment rate. And then so here, the increase in private sector investment was complemented by a 4.2% rise in capital spending by state-owned enterprises. And although general government spending declined 2% in the second quarter of 2023, it actually came off a high spike in the previous quarter. And as a result of these trends, total investment exceeded pre-pandemic levels as it rose to 15.5% of GDP, and this was from a low of 14% in mid-2021. And then quarterly profits in manufacturing and mining. This graph shows that in constant rands, mining and manufacturing profits have declined quite steadily since early 2022. And the fall presumably reflects the combination of lower export prices as well as increasing levels of load sharing. So we also look at FDI projects in the second quarter of 2023. So on this, if there are any questions or queries or any clarity required, my colleagues Rethabile and Kelello will be able to provide a lot more detail into some of these projects. But what we saw in the second quarter of 2023 is that there were a total of 30 projects and with an investment value of 259.71 billion, but this was only recorded from 27 projects. So overall, at least half of these projects were recorded in the manufacturing industry, while others were in mining services as well as utilities. So most of the projects added to the FDI tracker, I think this is an important note, is that for the second quarter, is that these were some of the projects that were announced at the South African Investment Conference, which was held in April 2023. So in the next 3 slides, I'm going to take you through the briefing notes that we received for this edition of the REB. So as I mentioned in the beginning of my presentation, we received 3 briefing notes. And the first briefing note is a briefing note by Neva Makhetla, and it's on the internal migration and industrial policy. And this briefing note is on the deadly fire in Marshalltown that saw at least 77 people losing their lives. And according to the note, the fire highlighted the failure to accommodate the influx of migrants in South Africa's urban hubs for economic and social development. And the discriminatory citizenships policies that we saw under apartheid that restricted the movement of people to urban areas led to a large and enduring migratory wave since 1994. And so when we look at industrial policy, according to this briefing note, is that in response to migration, it has often focused on creating new industrial centers, and these are industrial centers in rural areas, instead of actually integrating newcomers into urban agglomerations. And so the note also points to the fact that in the 1990s, around 20 million people lived in impoverished and overpopulated homelands. And there has been very little change, for example, in population estimates in those areas over the years. And when we look at urban areas, particularly in Gauteng, There has been significant population growth since 1994, and particularly when we look at Johannesburg's population, it's been growing by 145%, and for Tshwane, 120%, and Cape Town, 90%. And so the economic realities have played a significant role in people's decision on where to live, with Gauteng experiencing 105% expansion in its economy and also generating over 1 million net new jobs since 1994. So for government services and retail, these are evenly distributed across the country and also in line with the population. But then when looking at other sectors such as manufacturing and also financial services, these are largely concentrated in urban areas, for example. So to conclude, the briefing note states that there is a need for a pragmatic spatial policy that considers the economic potential of different regions rather than actually committing to developing or planting industrial centers in all areas across the country. And it also acknowledges that the political and historical factors have actually made it challenging to make tough decisions regarding the spatial economy in South Africa. So the second briefing note is a briefing note that speaks to the TIPS report on localization. This is a report that was previously published by TIPS, and it's available on the TIPS website, and it's a briefing note by Niva Maketa, who was one of the leading authors on this report, I think to work together with Nokwanda Maseko. And so on this briefing note, so the aim of the report is to assist practitioners in determining when localization is actually practical and appropriate, and it also suggests changes in the procurement systems in order to improve outcomes. So the report mentions, the note mentions that localization assesses the demand for imports as an indicator of when domestic production is justified, and not only relying on tariffs, but also on reforms to the procurement system and also measures to address supply side constraints, such as, for example, training as well as infrastructure. So unlike traditional import substitution strategies, the briefing note mentions that localization does not exclusively target final consumer goods, but it also focuses on capital, intermediate products, and also services. And this also includes those in export-oriented value chains. So in terms of the localization strategies, the briefing note highlights that these are often based on two arguments. The first argument being a bias against local suppliers in public and private procurement policies, and also the second argument being the infant industry approach, which acknowledges that producers may need support before actually competing with established foreign suppliers. So then the core question in localization is whether the cost of state support is justified by the benefits of diversifying the economy, increasing local production, as well as creating employment opportunities and jobs. So possible challenges in implementing localization highlighted in this briefing note is that it includes, or can include higher prices or lower quality for consumers, supply side measures to support local producers, and also reforms to procurement systems. So in terms of government departments and how this can be a challenge for them, the briefing note highlights that departments may face budget constraints when implementing localization, especially in areas like healthcare and education, for example. And then to conclude, the briefing note points to reforms to public procurement systems being recommended, including engaging with DTIC in terms of ensuring specifications do not exclude local suppliers, the prioritizing of localization in departmental KPIs, establishing a cost-benefit system, as well as funding price premiums from an industrialization fund rather than departmental budgets. So the last briefing note looks at the board program for training development economists, and this briefing note is by Saul Levine. So the program is an annual high-level training program in development economics, and it's funded by the DTIC. in order to build capacity in Africa. And the program is also supported by SACHI, based at the University of Johannesburg, and it's administered and co-facilitated by TIPS. And the program focuses on improving how Africans think about and implement industrial policy in developing countries, with a particular focus on Africa. And since its inception in 2007, APPORD has actually had more than 600 participants, with a goal of building capacity in industrial development across the continent. And during the program, there are public lectures that are delivered by professors and economists from around the world. And they cover a wide range of topics ranging from structural change, deindustrialization, the middle income trap, gender, global value chains, inequality, anti-corruption, as well as labor markets, as well as some case studies focused on experiences of economic development from different regions, including some regions in Africa. There was an interesting study on Ethiopia, for example. There were examples from Latin America, as well as East Asia. And the program provides participants with insights to critically evaluate policy options, and it also offers a heterodox perspective on industrialization and also on economic development. And it also emphasizes the importance of evidence-based research. And lastly, the APPORD program fosters engagement among South African officials, researchers, academics, with colleagues from across the continent through an established APPORD alumni network. And for any questions on APPORD, Neka attended this year, so the DTIC colleagues can reach out to her, but it will be really great to see more DTIC colleagues attending. It's a really amazing program. So that's it for me. If you have any questions, I am available to answer them. Thank you. Any questions from the room? Yes, Fanie.
Thank you, Lesego, for the presentation. You've indicated mining exports declined by 20%. I want to get a sense from you, because according to newspaper reports, Chamber of Mines indicate they can actually export a lot more if Transnet Freight Rail can get the commodities to the harbor. And then they also say, well, if TNPA can provide better level of service to exporters, they can, the exports will increase. I wanted to get a sense, is it the decline, do you think it's primarily due to the lower price in the commodities, or do you think part of the decline, especially in mining exports, is just due to the fact that Transnet TNPA cannot really provide the level of service and capacity that our exporters require? Thank you.
Thank you, Fanie. Wendy, I'm going to ask my colleague Wendy, who works on the export tracker, to respond to that question. I don't know if Wendy, she's online. I don't know if this is a question you're able to respond to now, or if you are going to cover it in the export tracker.
Hi, Lesego. So I actually referenced the REB as well on the decline of mining exports, but I agree that it's actually a combination of both factors. So it's the lowering in the prices of commodities, as well as the issues with Transnet and the inefficiencies at the port. So we're actually seeing through the export tracker that a lot of the mineral ores are going through the Mozambican port, and I will touch on it in further detail in the export tracker. But it's definitely both factors reinforcing each other, the decline in commodity prices as well as the inefficiencies that we are experiencing in our ports at the moment.
Thank you, Wendy. Any more questions in the room? Yes.
Thank you. Thank you so much for the presentation. My question is around utilities. I got that, with the increased investment, we had a lot of imports for renewable energy alternatives. Which is but at the same somewhat driving towards localization to ask if there is any opportunity for us in the near future to actually import less when it comes to renewable energy sources, and therefore we try to grow manufacturing sector within that, because we still have those energy challenges. And I think even if we come to a point where it's all resolved, renewable energy is still a preference.
Yeah, thank you for that question. I think that's a very important question. And I think the first part of my answer is related to the SARM, which is the South Africa's Renewable Energy Master Plan. And I know that it's focusing on localization opportunities, exploring those opportunities for South Africa, primarily looking at solar, wind, as well as batteries. And last week, TIPS hosted a development dialogue on the localization opportunities for battery manufacturing in South Africa. And we're seeing that with load shedding, as well as in terms of creating a more reliable and stable electricity grid, batteries are very important. And there are South African companies that are producing battery for the stationary storage market. And so those opportunities do exist in South Africa, but however, there is support that is required, not only from government in terms of policy, but also from development financing institutions to actually make sure that we are getting those industries to scale, but also that there is speed, since we are seeing increasing demand for those renewable energy technologies in South Africa. So there is absolutely huge potential in the country in terms of actually being able to locally produce batteries and solar panels, for example. Any more questions in the room?
Thank you, just one more on the household consumption. You see, you mentioned it is down primarily due to the high inflation and also high or interest rates that are quite high.
So the high interest rates that we're seeing, as well as inflation, are a contributing factor to the decline in household consumption that we're seeing in South Africa. Yeah. Are there any questions online?
Yes, Chair. Can you hear me?
Yes, we can hear you, Charles.
Yeah, I'm Charles Dednam from the South African Iron and Steel Institute. Two remarks that I would like to make with regard to the briefing notes. The one is on urbanization. I think urbanization, as you've indicated, I think it's a serious concern. And it's something that we need to address quite urgently. But it is not only a South African phenomenon, I think it is actually coming worldwide. We recently had a session with World Steel Organization at the Steel Summit, where they've actually indicated how the trend has actually escalated worldwide, and especially in the developing world. And I think it is something that one needs to take cognizance of as we need to make policies relevant to actually accommodate this trend going forward. And if we do not do something about it, we will be in serious trouble doing that. Okay, so that's the one thing I just want to mention. The other one is on localization. I totally agree that localization cannot happen at any cost. Localization needs to be applied very carefully. But one thing about localization and the result of localization cannot really just be a textbook type of approach towards localization. In South Africa, it's very real that localization is actually bringing about, and the imports are actually bringing about the lowering of quality and standards into the country. And it is basically driven by the huge overcapacity of manufacturing in the country itself, and due to the low demand factors and the low growth situation that we are currently in. So the people are actually trending to bring in cheaper products to maintain margins and to keep their market share in the market. And I think that one needs to be very much aware of this factor happening to us. So we've got a huge fight on the steel side with regard to low quality imports that are actually coming in at ridiculous prices. So it is whether one want to allow that in the market, and you will just demolish your total manufacturing base completely. Thank you so much.
No, thank you so much for that, Charles. I agree with you, and I think when we're looking at batteries as well, the issue of standards is one that's very important, because the market is currently flooded with battery imports from China, but then the South African local manufacturers are actually able to make batteries that are better quality and standard, and also ones with warranty. So that's definitely a very good point. I think I'm going to move on to the next presentation. And so the next presentation is on the FDI Tracker. And this is a tracker that examines foreign direct investment projects occurring on a quarterly basis in South Africa, as well as also looking at investment environment trends. And this presentation will be presented by my colleagues, Rethabile and Kelello.
Good morning, colleagues. As Lesego has mentioned, my name is Rethabile, and I will be presenting the 2023 FDI Tracker, along with my colleague Kelello, who's on my right, but you can't see her at the moment. So, as mentioned as well in the REB presentation, so there were 30 projects recorded this quarter, meaning that this presentation might be a little long, so please can you bear with us. So the contents of this presentation, we're going to start with introducing what the tracker is, explain the FDI Tracker dataset, the data we collect, the limitations, the investment environment, then the overview of the 30 projects that were tracked this quarter, along with the project trends, how credible these projects are, the barriers and constraints, the projects that were updated this quarter, as well as the concluding insights. To introduce the tracker, firstly, it traces FDI that are made in the country every quarter based on publicly available and published data. I say this thing every single quarter, but people tend to think that we have some secret database, but we don't. This all comes from information in the newspapers, for example, online newspapers, company reports, press releases, etc., and is project focused. What it aims to do is to assist policymakers and other relevant stakeholders in understanding the types of investments which are made each quarter, and to assist in better understanding the environment in which investors operate. The data that we collect on in the tracker on a quarterly basis, there's basic data which you can see on the left-hand side of the screen. The name of the project, the value of the project, where this project is going to be situated, etc. And then on the right-hand side is the policy-related data, which is the motivation for the investment, the target market. Is it a project that is just for, that is domestic or regional or international or a combination of the three? The social benefit programs, government engagement, very importantly, which companies do not always report, the issue of jobs, how much permanent employment is going to be created and temporary as well. And then again, the credibility grading and the barriers and constraints which were reported in the quarter as well. The limitations of this project, which is very important to note, is that it only, again, reports on projects that are publicly available. There are some sectoral biases where some sectors are more visible than others in terms of being reported on in the media. As well, the tracker reports when investment is announced, but of course, capital investments take a long time to occur. And then lastly, it's also important to note that pledged and announced investments do not always materialize. And if this is the case, if it is reported in the media or in company reports, etc., the tracker accounts for this as accurately as possible. So the first section of the report, or for this presentation, we look at the investment environment, and we look at 4 indicators. And what the section of the report aims to do is to provide insights into the general environment in which investments take place, as well as providing a glimpse into general investor sentiments. So the first indicator we look at is the inward investment, which is calculated for us by the South African Reserve Bank, the SRB. So direct investment increased by 0.8% in the quarter. Portfolio investment increased by 1.3%, and so did other investment by 0.6%. So there was a total increase of 0.98% in the quarter. And this was largely due, well, the direct investment, the increase was largely due to Heineken finalizing its acquisition of Distel. The second indicator we look at is GFCF, which increased by, just want to move that quickly, 3.9% in the second quarter of 2023. Private investment increased by 5.7%. Investment by state-owned companies increased by 4.5%, and investment by general government decreased by 2.6%. What Status cited for this 3.9 increase was mainly an 11% increase in machinery and equipment, 0.3% increase in construction works, and thinking about how it was also cited that the increase in GFCF was also due to companies being forced to invest in alternative energy solutions due to the load shedding crisis that we're currently facing. And these are mostly investments into lithium batteries and solar panels. So the third indicator we look at is the Absa Purchasing Managers Index, also known as the PMI. So in April 2023, it amounted to 49.8 points, which is an increase, a slight increase from the end of March 2023. And the BER noted that the slight increase was due to the increase in inventories index, but it remained below the 50-point threshold, mainly due to load shedding's impact on output, as well as demand remaining under pressure from March 2023 as well. In May, there was a slight downtick, and this was largely due to the decrease in expected business conditions in 6 months' time, which decreased from 51 points in April, to 43.7 points in May. And it was noted that this is the most pessimistic that purchasing managers have been since peak lockdown in 2020. In June 2023, there was another decrease. This was a bit larger than the one between April and May, and this was largely attributable to weak demand, as well as domestic demand remaining under pressure. And on average, the Q2 2023 PMI average was 48.9 points, which is below the 50-point threshold, meaning there was less, declining rate in manufacturing activity in the second quarter of this year. And then the last indicator we look at as part of the investment environment is the leading indicator, which we calculate on a quarterly basis. There was, what this indicator aims to do, is to predict future economic activity, and it serves as supplementary evidence for future changes in the economy, and is calculated based on several underlying data sets, such as building plans approvals, which would indicate, for example, future construction activities, and job advertisement space, which would indicate potential jobs that are available in the economy. In April of 2023, there was a 1% decrease, which was largely due to deterioration in the BER's business confidence index and a narrowing in the interest rate spread. In May, there was another decline of 1.7%, and this was due to the number of building plans approved and a decrease in a decrease in South Africa's export commodity index, which is denominated in the US dollar. Yeah. Thank you. And in June of 2023, there was another decline of 0.1%, which was largely due to the narrowing in the interest rate spread and a decrease again in South Africa's export commodity price index, which is denominated in the US dollar. So now I am going to hand over to my colleague Kelello, who will speak to the 30 projects that were recorded in the tracker this quarter.
Thanks, Rethabile. Good evening, colleagues. As has been indicated, we recorded 30 projects this quarter, 23 of which are from the investment conference. Only 7 were announced outside of the conference. Just to give you an indication of, in terms of value, one project dominated, and this was a commitment from the president of the UAE that they would invest 190 billion into the South African economy. There hasn't been that much clarity on what the investment would entail, except for the sectors in which the investment would go. In terms of number, the majority of projects this quarter are valued below 1 billion. You can see that with the small pie chart on the right. 12 of them are valued between 1 billion and 100 million, and then 7 projects are valued below 100 million. In terms of jobs, we recorded 3,749 employment opportunities. This is from 6 projects, so basically only 6 investors announced that their projects would be creating employment. In terms of the industries in which these jobs will be located, there are 3 manufacturing. In terms of permanent jobs, there will be 3 projects will create jobs in manufacturing, 2 projects will create jobs in mining. Then also with permanent jobs, in terms of the types of investment, 4 of these are greenfield and 1 is brownfield. Then 500 temporary jobs were recorded. All of these are in manufacturing, and this is from 1 project, and it is a greenfield investment. So we analyze FDI by industry and subsector, and in this quarter, multiple basically represents the single commitment by the UAE. So it kind of distorts the data a little bit because of its size. But when we get further into the data, we see that mining had the largest investment value, and there were 5 projects, and it is divided into 3 subsectors. The largest was metal ores, with Anglo's 29 billion rand investment into its operations. Then in terms of manufacturing, it's divided into 3 subsectors. Sorry, it's divided into 3 subsectors. And the largest is beverages, which is a result of SAB's investment also into its facilities. Then we have services, divided into 3 subsectors. Biggest one is telecoms as a result of Cassava's investment also into its business units, which include Liquid, Africa Data Centers, and a renewable energy firm, dtic. Then in utilities, this is entirely renewable energy investments, and there are 3 projects here, including ArcelorMittal's 3 billion rand project to install solar facilities at its Rethabile Park Works plant. Then construction, we have 1 project that is Citibank, which announced that it will be investing 1.4 billion into the Vaal River City project, which is an infrastructure initiative in partnership with the South African government. Then finally, wholesale and retail trade. There are 2 projects here. One is Bata. I think we're all familiar with Bata shoes. They make tuckies. They'll be investing in their facilities and also introducing international brands other international brands into South Africa. And the other one is De Beers. They have completed their site holder sales facility, which is basically where they sell their raw diamonds through a network. When we look at investment by stage and type, most projects are still at the announced stage. Majority of these are in manufacturing. Then in terms of construction and implementation, only 6 projects are under construction, most of them in mining, including a company called Ungwe Platinum in Limpopo. They have started construction of their mine. At project preparation, we have 4 investments, including liquid telecoms, and then complete projects we identified previous quarter. Then in terms of projects type, the ones that we designated as not reported, that is the UAE investment, as well as another company called Prism. With this one, we struggled to establish details of the project. So there wasn't substantial information on the project. So those 2 are classified as not reported. Then in terms of brownfield projects, they account for 30.6 billion, and there are 7 of these projects. In terms of greenfield investment, they are in the majority with 12 projects. 8 investors announced that they would be undertaking expansions, where 1 investor is doing an upgrade, and that is BMW with the electrification of their facility in Roslyn. By local value, again, this is by virtue of the UAE investment. They at least indicated where they intended to spend their money, I guess. Then we have Housing, which had the highest number of projects announced, largely in manufacturing, Limpopo dominated by mining, the Northern Cape also dominated by mining, that is in terms of value. The Northwest and Free State entirely comprise Anglo-Americans' investment into its operations. Then in the Western Cape, it is dominated by services with 7 projects in total in the Western Cape. KwaZulu-Natal, 9 projects were announced, the largest in manufacturing. Then Mpumalanga was 1 project, not reported, is Rheinmetall Denel. They haven't indicated where the balance of their investment in renewable energy projects would go. When we look at FDI by origin, the Middle East had the largest representation by virtue of the UAE's investment, but also we see Turkey featuring and representing the Middle East through DeFi's 288 million rand project. Then Europe is represented by a number of countries, predominantly the UK with a 29 billion investment coming from Anglo-American. Then Asia represented by China and South Korea, China dominating with projects in mining. Then Africa is represented by Nigeria with 1 project. Access Bank is investing 1.42 billion into the economy. When we look at projects by target market, so this is just basically to say where they would be directing their investments, which markets they want to attract. Domestic, again, UAE is overshadowing the others. Then in terms of domestic, regional, and international, predominantly these are mining projects. And then when we look at domestic and regional split between services and manufacturing, there are 10 projects in this category and 1 project that is looking at, that has a domestic and international focus. So by credibility grading, this is just to say there are some projects that won't necessarily materialize. And this is just a measure or tool for us to say to what extent or to what degree do we say a specific project is going to happen, and also just based on the information that's available on the project. So commitment is at the lower end of the spectrum, and there are 5 projects in this category. And this is just simply because information available on them is limited to what was announced at the investment conference. So all we have is value, industry, and just a brief description. I just want to point out that the Prism Group, in addition, they're a relatively new entrants, but again, it's very vague in terms of what the company is and where they are from. I think in terms of potential, most of these projects, they lack specifics, but at least there is some clarity on what the project entails, where it will be located, and they have a limited information on the development plan. Then in terms of likely, which is at the higher end of the spectrum, this is where there's more information. Ultra manufacturing facilities, for example, they've recently completed a facility. They have laid out timelines for their projects. They have values, and there's a project outline, and they are preparing to commence implementing the project. When we look at barriers and constraints, this is just to say the companies have been having certain issues, and this is what they're struggling with, or this is how they've attempted to resolve them. There's only 1 project, and that was the Ngwa Platinum Mine project in Limpopo. So they indicated just regulatory challenges which delayed the development of the mine. I mean, the initial investment was in 2014. It took 7 years before they could start construction. But they did have a positive comments about South Africa. So just projects that were updated this quarter includes the Heineken investment that was mentioned by Rethabile. Once the acquisition was wrapped up, they further announced that they would be investing a total of 15 billion into the economy. This is part of the conditions set out by the Competition Tribunal. Right, so just to wrap up, because I know I am out of time, just some insights from what we observed this quarter. Manufacturing, mining, utilities, and services continue to be the main industries that attract investment. Europe as a region continues to be the largest investor into South Africa. And there's continued investment in sustainability projects. Western Cape, Gauteng, KZN, still the top investment destinations. We are seeing Northern Cape, just to indicate renewable investment. It's quite popular with that. Then with the number of greenfield projects that we are seeing, it is a positive indicator of investors being interested in continuing to invest in South Africa. Then just a steady progression of previously recorded projects where there is movement and they are progressing. Thank you very much.
Thank you. Thank you very much to Rethabile and Kelello for the presentation and for highlighting some of the FDI projects that we're seeing in the country. And also, I think that when it comes to the FDI Tracker, the TIPS team does amazing work, despite some of the drawbacks and challenges that Rethabile pointed out. So well done to you guys. Do we have any questions in the room on the FDI Tracker? Yes, Fanie.
Thank you. Yeah, this is very useful in the sense that the DTIC also tracks FDI via our APP. And one of the companies that we've identified, I couldn't see it on the list here, was investment by Benteler. It's automotive, I think automotive component or similar. It is quite a big investment. I think it was announced towards the end of September, maybe early October. I don't know. So I just want to get a sense of, like I said, I couldn't see it on here. So I just want to have a sense of that, please.
If it was announced September, then it's going to be part of
the next
3.
Oh, okay.
Yeah.
All right. Thank you. That's fine. Thanks.
Thank you, Fanie. Yes.
Thanks for the presentation. I noticed that government investment shrunk, but then these investments coming through and the construction sector seeing an increase. So my question is around the fact that government provides incentives and co-funding towards a lot of the investments that comes into the country. So, the shrinking against the increase, is it because our co-contribution as government is minimal, or what could be the reason there?
You'll take it? I'll take it. So the challenge with our approach to how we collect the data is, unless it's on hand that, this project is co-funded by government, and also just the value or weight of that government support, it's difficult for us to establish, the extent to which government has co-funded a project. So there are instances where, it's clearly outlined that, for example, the Citibank project, we just don't know what the value is, but they have indicated that the project will be developed in partnership with the government of, with housing provincial authorities. The DTIC is also involved through an incentive program. But the value or weight, that is the information that we currently don't have access to.
Thank you, Kelello. Any more questions in the room before I move on to the colleagues online?
Can you hear me, guys?
Got it right.
As the presentation was going on FDI, one of you can't remember which, I'm sorry, my brain is just scrambled today. Okay. Mentioned that some of a bit of the investment was the wrong investment. So it took me back to, my usual question that, guys, it's very useful to hear about these investments so that we see what's happening and are able to understand, the movements in the various sectors. And with respect to the renewables specifically, I think I probably mentioned this before, that as much as we're seeing the uptake, the fact that we are calling for this to happen locally is for a good reason, that we need the energy. So I said previously, and I wanted to raise it once more, are we getting to a point where we're starting to track the impact in terms of, the weight of these investments on the, energy availability sector and manufacturing in the country? Is it something TIPS can take up and start really mapping what is the extent, what is the impact, and how much more perhaps do we still have as a deficit energy-wise? I feel that is something that we need to start really putting to bed, so that our work, or rather TIPS's work, makes me feel really equipped. So I don't know if you guys are moving towards that.
Yeah, that's Very good point. It's something we should actually consider. So usually those types of projects are done at the end of the year. If there is time, of course. But it would also require us to work with some people that work in the green team as well, that work on these types of projects. So it definitely is something that can be pitched.
Yeah.
And I'll take it up with the managers and see what we can do about it, because it definitely would be useful to us and to everyone else as well. So yeah, definitely, it is noted, and we will see what we can do about that.
So thank you so much. Appreciate that.
Yeah, thank you so much for that very important question, and thanks to the family for the response. Before we move on to the next presentation, can I take one or two questions online, if there are any? Please feel free to raise your hand. I think there is a question. Okay, cool. Nick, so for the people in the room who can't see Nick's comment, he's requesting if we could please append a list of clarification of acronyms used in the presentations to the record of the seminar. We can definitely do that for you, Nick. Thank you for raising that point. Any more questions from the people online? Okay, I think I can move on. Thank you again, Rethabile and Kelello. So next we have the import localization study that will be presented by Rapula. So the import localization and supply chain disruption study comprises quarterly reports that identify goods from the list of imports in the import tracker, whether they have previously been manufactured locally in South Africa or not, but which South Africa could possibly viably manufacture. Rapula will be presenting from online. Rapula, over to you. You have 15 minutes.
Thanks, Lesego. I'm not sure if I can do it in 15 minutes, but I will try my best. If you could just give me a moment for me to share my screen.
Thank you.
My name is Rapula Diale. I'm an economist at TRIPS, and today I will be presenting the imports localization and supply chain disruption study for the first quarter of 2023.
Am I audible enough?
Yes, we can hear you.
Extremely.
Yeah. But this is better. So stay where you are now.
All right. I'll try not to move too much.
Yeah.
Was compiled by senior economist Nogwanda Maseko, supported by myself, Rapula Diale, Rethabile, Molala, and Masana Baloi. The report contains an introduction which will capture the aims and purposes of this report, what this report seeks to achieve. It will then discuss a snapshot of trade analysis and then move into product analysis of the selected products. It will finally provide a discussion of a designated item, which in the context of this report is cement. As a way of background, this report is set in the backdrop of the COVID-19 pandemic, which triggered significant supply chain disruptions, causing many countries including South Africa, to consider the concept of import localization as a strategy to boost the local industrial base. To achieve this strategy requires a thorough understanding of a country's industrial capacity, as well as awareness of local and global demand traits that could impact on the success of the strategy. Therefore, to support this goal, the import localization supply chain disruption study is a quarterly report designed to identify specific product from the list of top 200 imports captured in the import tracker report. The primary aim of this report is to assess South Africa's potential to domestically manufacture items featured on the top 200 import list. The items or the products selected for this analysis are selected on the following criteria. First, they need to be included in the top 200 list of import items based on the rand value. Secondly, they need to be inputs or utilized in the production of high-value export products. They need to serve as inputs or final products of high demand markets, both locally and regionally, as well as to have a quarterly value exceeding 150 million. Once the products are identified on the list, what we do is that we use a blend of data analysis, desktop research, and where feasible, interviews with companies and industry organizations. The data used in this report or presentation is primarily sourced from the South African Revenue Services, SARS, as well as TradeMap. When we look at trade in the first quarter of 2023, we will see that South Africa had a trade deficit of 5 billion in the first quarter of 2023, which is the first trade deficit in the first quarter since 2019. The deficit was driven by a decline in exports during a period of growth in imports, wherein exports declined to almost 500 billion in the first quarter of 2023, down 7 billion from the first quarter of 2022. Over the same period, imports grew by 60 million to nearly 500 billion in the same period. When we look deeper at the context of trade, we will see that China, Germany, the United States, India, and the UAE were the top 5 import sources in this period, with imports from this country amounting to nearly 50%, 47% to be exact. And when we look at the top 2 nations or top 2 import sources, we'll see that China grew by 16 million to just under 100 billion. Did I say 16 million? I meant that China grew by 16 billion to just under 100 billion in the first quarter of 2023, with the key items coming from China, or the top import items coming from China being smartphones and lithium-ion batteries. Germany, on the other hand, which is the second largest import source, jumped from 11 billion to just under 40 billion in the same period. And the items, the export items to South Africa was dominated by automotive imports, this including components as well. Diesel has had quite an impact on trade, particularly with the closure of key refineries and the loss of critical domestic refinery capacity. And so we look at the import or the trade of items such as diesel and crude oil. When we look at diesel, the import of diesel grew by 18 billion in the first quarter of 2023, however, underwent a quarter-on-quarter decline by 7.4 billion. Crude oil, on the other hand, continues to grow in the first quarter of 2023, up from 18.3 billion in the first quarter of 2022 and 11.4 billion in the quarter before that. On the export side, there was a marginal increase of 0.2%, with export amounting to just under 180 billion, wherein exports to China rose by 13 billion to 56 billion over this period. And export to Mozambique, predominantly destined for Rio exports, grew by 5.5 billion. This all the while exports to the US, Germany, Japan declined by a combined 80 billion, with Germany accounting for 61% of that 18 billion. Now, moving on to the product analysis section, we begin our analysis with the analysis of wheat and maize, which is a grain crop produced for human and non-human consumption and is used in the confectionery value chain, cereal value chain, as well as feedstock value chains, amongst others. When coming to the production of wheat, South Africa is ranked as the second largest wheat producer in the SADC regional bloc, with wheat being the second most vital grain crop after maize. And because South Africa has experienced significant decline in the total wheat planted area between the year 2000 and 2022, which amounted to just over 360 hectares, there's been a notable drop in the production volume of wheat, totaling just over 300,000 tons. This has meant that local wheat production has only been able to cover about 57% of the domestic consumption requirement, resulting in a significant deficit of about 1.3 million tons in the year 2020. Despite this challenge, these challenges, there seems to be some optimism that the current year's harvest will see good yields, which will help offset the reduction in the planted areas. In looking at the trade of these products, first we look at the table that is provided on the presentation. We will see that this product ranked 26th in the list of the top 200 import items by value, generating about 2.4 billion in import, and is a 12th most ranks 12th in the list of the top 50 imports by quantity. When looking at the graph that is provided, what we will note is that South Africa is a net importer of this product, with the trade deficit averaging 1.8 billion between the first quarter of 2013 and 2023. Import figures in the first quarter of 2023 show a slight decline to 2.4 billion. It says here million on the sheet on the presentation, but it is actually 2.4 billion from 2.9 billion in the first quarter. And in that quarter, Poland and Brazil emerged as the primary sources, each contributing around 26% of total imports by volume, with additional contributions from Lithuania, Russia, and Australia. In the same quarter, South Africa's wheat export saw a substantial increase to just under 840 billion, surpassing 650 billion in the same quarter. This, all the while, the volume of imports also exhibited growth, reaching just over 100 million kilograms in the first quarter, compared to the 102 million kilograms in the previous quarter of 2022. Primary destination for South Africa's wheat is other African countries, particularly within the SADC regional bloc. Our second product of analysis includes extract, essence, and concentrate of coffee, which are products that are derived from coffee beans and are used to impact coffee flavor and aromas to various products. These products are typically not made in South Africa. However, they ranked 164th on the list of top 200 imports, valued at 380 million, and are used across various value chains, predominantly in the food value chain. Despite the uncertainty of the production of coffee or of this product in South Africa, we can note that the country has limited coffee productions, primarily in the KZN and Mpumalanga regions, with total cultivation area approximating 200 hectares. As a consequence, South Africa relies on imports for this product. The trade deficit for this product has averaged about 27 million rands, or 1.5 kilograms between 2013 and 2023. In the first quarter of 2023, imports of coffee extract increased to 380 million, representing a 2 million kilogram increase. This marked an increase from 310 million rands to 310 million rands to 380. When looked at in terms of kilograms, in terms of volume, it is a jump from 2 million kilograms to 2.6 million kilograms. In the first quarter of 2023, the top 4 import sources of this product accounted for 78%, and these include countries such as Germany, which contributed 23%, Spain and the Netherlands each contributing 21%, and the Czech Republic contributing 14%. While imports of this product from within the continent remains minimal, South African export of this product is predominantly within the continent, and again, it is dominated by the SADC regional bloc, which accounts for 77% of the total exports of this product. The third item in our analysis include folding cotton boxes and cases of non-congregated paper or paperboard. These are packaging materials widely employed in the packaging industry for a versatile use of packaging industries such as pharmaceutical, retail, and cosmetic goods. The product ranked 150 in the list of the top 200 products by value, which generated 430 million and is operational in the packaging value chain. In South Africa, the paper and pulp industry experienced an increase in local manufacturing sales, reaching about just under 100 billion in 2022 from 96 billion in 2021. The country's total paper and pulp production in 2022 amounted to about 3.7 million tons, of which 15 million tons, 1.5 million tons was intended for packaging and paper. South Africa has maintained a trade deficit in this product since the first quarter of 2015, with the deficit notably increasing since 2018. However, in the first quarter of 2023, imports of this product saw a significant upswing, reaching 430 million, a substantial rise from 169 million in the first quarter of 2022. Germany stands as the top or the primary import source for this product, contributing about 2.9 million kilograms of the product, or 165 million rands. This is closely followed by the Netherlands, which exported 2.5 million kilograms, or 145 million rands of this product to South Africa.
Okay, so ethyl and alpha olefins. With this is a plastic copolymer, so it's part of the building blocks to a plastic commonly known as a linear low density polypolymer, and is a material that is used in the plastic value chains. It was ranked number 191st in the list of the top 200 import items by rand value, which amounted to imports of which amounted to 336 million. What is key with this product is that Sasol is the only producer of this product, and it uses fossil fuels as the key input in the manufacturing of this product, making it seen as unsustainable within the industry, and leading to the debate around the use of more sustainable input. Nonetheless, this product is primarily supplied by the US and Saudi Arabia, who are of course a key player in the petrochemical industries, contributing 86%, combined 86% by volume in the first quarter of 2022. Now, because there's another plastic product in this analysis, I'll just quickly jump on to the next product, which is polyethylene, which is again another plastic polymer that is used in a variety of plastic material, this time including low density polyethylene, and the same as the low linear density polyethylene that was discussed in the previous slide. This was ranked number 119th, mostly because it is a more versatile use of plastic, particularly in the automotive industry, gaining a lot of prominence there. Similar to the previous slide, this material is produced by Sasol and Safripol only. No other company has the capabilities of producing this product. And like the previous slide, it uses fossil fuel as the main feed, which has led to the rise of awareness in green polyethylene derived from fossil fuel, and is something that can be expected to sort of grow within the foreseeable future. Exports for this product has gradually increased, growing from 57 million in the first quarter of 2018 to peak in the first quarter of 2023 at 367 million. This export can be attributed to the increasing shipments to markets such as India, Spain, and Brazil, which have prior to 2021 have had limited export of this product from South Africa. And then just closing off, I'll just jump into the selected product for designation, which is cement. Now, with cement, there are at least 5 HS codes. So these are 5 different sort of products that are encapsulated in the cement segment of the designated product. It was designated in 2001, November of 2001. And despite, this report sort of seeking to answer the question of whether there's been an impact derived from the designation of this product, the time that has lapsed since then hasn't been sufficient enough for us to draw a conclusive claim. And in addition to that, this coincided with the coronavirus pandemic.
Thank you, Rapula. Okay, I think we're out of time for Rapula's presentation, but thank you so much, Rapula, for the presentation, and also thank you to the contributing authors for the very important and insightful work on the prospects of localization in South Africa for some of these products. So I saw the 2 questions online, and so I will be taking the first 2 questions online, and then we'll move to the room. I'll also be taking a maximum of 2 questions, if that's okay. So Freddie, I see that your hand is raised, but before your question, so before I get to you, Freddie, I would like to, for the people in the room, I'd like to read out the question by Nick. And the question is, what value is used to do trade analysis? Is it declared rand value of the import? I think that's a question for Rapula. I think there was another question, right? No? Okay, Freddie, I'm going to hand over to you to please ask your question, and then after you're done, I'm gonna hand over to Rapula to answer the questions. Thank you. You're more than welcome to unmute yourself, Freddie.
All right, thank you so much. This was really insightful presentation from Rapula. And my question really is, on the list that is generated of 200 items, is that list available? Can you share that with us? And I must just mention that I'm part of MEMSA, Mining Equipment Manufacturers of South Africa. So what I would be very keen to know is, of those 200 products that product groupings that they've identified, which ones are mining inputs that we can look at from a mining sector point of view? And also, I just wanted to know if there's a possibility to share the list with export councils around the country, so we can also ask them the question as to, is it viable at all to look at localizing the items on the top 200 list. Let me stop there, Chair. Thank you.
Thank you very much. I'll take 2 questions in the room. If there are any questions, yes.
Thank you. My question is around certain sectors, for example, pulp and paper and polymers, where it was very clear that there are only a few players in the domestic market. You know, like polymers, we mentioned only Cecil. And I also know in pulp and paper, we have like 2 major suppliers and everybody else is still struggling, you know, to be part of the mainstream players. So, you know, in the case when we do have localization policies and designations, but what else is there to broaden participation? Because, you know, we're still talking about 1 or 2 players within a certain sector. So what else is there for this participation?
Thank you very much for your question. I'm going to hand over to Rapula to respond to the questions. Rapula, over to you.
Okay, forgive me, colleagues, for that. I got disconnected for a moment, so I was only able to pick up 2 questions. But I believe my colleagues are in the room and would be able to assist me in responding to some of the other questions. So, in terms of the selection criteria, whether we could include mining products on this list. These products are selected on the basis that they are manufactured products. So we do have other reports that contain mining capital equipment, not necessarily raw or mining outputs. So the key is to look at manufactured outputs. Yeah, in terms of the list, providing the list is provided on the report itself. It captures the 200 top import items for each quarter. So if you go back onto our website, you'll be able to find more lists on the related quarter. And then to the second question, yeah, what I'd like to highlight there is that the plastic and the plastic and the pulp and paper industries are very capital intensive industries, especially with the plastic industries that requires a lot of IP as well. Which makes it even harder for small players to come into that kind of space. But where we do see small players, a lot of SMMEs is in the production of plastic products, and with those small players, what they tend to do is import a lot of the primary plastics, mostly because they tend to be cheaper than having to maybe purchase from some of the local producers. Yeah, so that's the key challenge there with those specific sectors, the level of capital intensiveness that sort of creates a barrier for smaller players to come in the sectors. I don't know if maybe Nokwanda or any of my other colleagues might like to add to my comments.
Thank you very much for that, Rapula. Any additional comments can be put in the chat box, please. So next we have 2 more presentations remaining, and the first presentation is the import tracker, and then the second one is from the export tracker, which will be presented by Wendy, export tracker, and then import tracker by Nokwanda. So the trackers provide an overview of the import and export trends over the past quarter. So for the import tracker, it looks at recent surges in imports, and then the export tracker looks at the growth and decline in exports over the quarters. So both Nokwanda and Wendy have 10 minutes to present on these trackers. For the online people, if you do have questions, please do type them out in the chat, and yeah, my colleagues will be able to respond to them in the chat, just so we're able to save time. Both Wendy and Nokwanda are online, so We're starting with the import tracker first. So Nokwanda, over to you, please. Thank you.
Thanks, Lesego. I am hoping that everyone can hear me. Let me just put this in presentation mode. Can you see my screen and hear me clearly?
Yes, we can see and hear you very clearly. Thank you, Nokwanda.
Okay. In the interest of time, I am going to skip a few of the slides. I do believe that quite a lot of the colleagues from the DTIC would be familiar with the report and how we do some of the data analysis. But for those that are not familiar with it, as has been mentioned, we use SARS data and run that through our program to get the stuff that we need from it. And generally that includes the value of imports and the quantities of those particular imports. And I know Rabula previously mentioned that it's a top 200 list. For the purposes of the import tracker, we only do 100 and then we extend it to 200 in the localization study. But both data sets are included as annexures in the different reports. And then because the REB presentation would have covered quite a lot of the trade, I am going to skip this and move on to this particular slide over here. And the thing that I want to highlight here is the composition of the top 5 import items by rand value for the second quarter of 2022. And as has been mentioned, diesel imports were on the rise for quite a while. There was an increase in both the rand value of the imports and the actual quantities imported. But as you can see from the graph, the imports then fell to about 38 billion in the second quarter of 2023 from a high of 57 billion in the third quarter of 2022. And also in terms of crude oil, as Rabula mentioned, there's been decreased refinery capacity in the country. I am still waiting to see what exactly is happening with the Astron refinery, if it's back online as of yet. But what we've seen in the data is that crude imports have continued to grow in quantities, growing by 128 million kilograms in the year to the second quarter of 2023, even though the rand value is down. And that's just a reflection of the overall decline in commodity prices. And importantly, lithium ion accumulators, we've seen that surge by more than 13 billion to roughly 15 billion in the second quarter of 2023. From 1.7 billion in the second quarter of 2022, excuse me. And then continental trade, again, I think, a lot of the people that attend these sessions and read our reports would be familiar with it. But broadly speaking, South Africa is a net exporter to the rest of the continent, with, the trade surplus averaging almost 70 billion per quarter over the period between 2013 and the second quarter of 2023. Imports, surprisingly, from the continent did grow by a faster rate than exports, although I think given the slight increase in some imports of especially crude from within the continent would have affected the overall growth. And then South Africa mostly exports mineral products, but there is a slight difference in that this includes coal as well as petrol and diesel. And so the general trend here is that South Africa imports crude largely from Nigeria and in some instances Ghana and Angola, and then exports some of the refined products to the rest of the continent as well as then coal. At product level, at country level, as you can see from this graph, Nigeria again tops the list, and that's because of their provision of crude oil. And again, you can see that there's been notable decreases in the value of crude imports.
although there's a year-on-year increase between 2022 and 2023. And then Eswatini mostly supplies sugar and confectionery products to South Africa, as well as essential oils that are used mainly in the food and beverage industry, but also in personal care products. There are still some re-imports, although I have not included them in this graph, but there was a decline from 3 billion rands in 2022 to 1.6 billion in the second quarter of 2023. And those generally include foreign currency as well as other paper and paper publishing products. Foreign currency that would have gone out to countries such as Zimbabwe, for example, and then coming back into the country. And then in terms of exports, I think probably Wendy is going to go more into the issue of Mozambique, but there is likely also going to be a policy brief coming up in the near future on the issue of Mozambique. But over the past few quarters, we've seen a surge in exports to Mozambique, and that is largely ores and concentrates. And the reason for that is an agreement between Transnet and the Mozambique Port Authority to essentially move some of South Africa's road freight and use the port of Maputo for re-exports to especially Asian countries, although personally I have not been able to confirm which country exactly, but I know that this is freight that's been moved from road to rail and then it's taken to Mozambique for re-export. And then other countries to which there were exports include Zimbabwe as well as Botswana and Namibia. So most of the trade that happens is within SACU and then within the SADC region as well. And then what we've also been seeing since the end of 2019 is that there's products for which there is an increase in the imported quantities, but a decline in some cases of the rand value. Actually, it's the inverse. Excuse me. So there's a decrease in the imported quantities, and in some cases there's a increase in the rand value of the imports. And a sodium carbonate is an example of that, where there is a 0.3% decrease in the imported kilograms, but there is a 39% increase in the price. Similarly, cards incorporating one or more integrated circuits, as well as automotive components. The auto components is particularly important because we know that has spillover effects for the auto industry. But what we have seen, surprisingly enough, is that even though there's a decline in the imported components for passenger vehicles, there's actually an increase in imports of components for goods vehicles. And that trend also seemingly holds for the actual autos. And then we have extracted just the top 25 items that are included in the list. As I said, the rest of it would be in the annexure that's attached to the report. This list is generally broad. And as you can see here, number 8, that would be some of this is the solar components, which are designated at around 70%. And then number 4 would be the lithium ion accumulators, which is actually up more than 27 spots to number 4. And then an analysis of products that we've previously looked at, you can see the overall trend in some of these products. But we have noted that some of especially the petroleum products like petroleum bitumen, as well as residual fuels and aviation kerosene. Generally, even though the trend might be slowing here and there, generally those imports are still high. And as has been mentioned, this is affected by the refinery capacity. And so if we're refining less crude oil, we're also then getting fewer end products, and that also includes especially these products listed here, like bitumen as well as residual fuel oils. And then for the quarter, the product that was selected for analysis that showed a surge in imported quantities is anthracite, which is also known as hard coal, which has various industrial applications, including as an energy source in steel manufacturing, as well as a general feedstock in the production of ferroalloys. It is also used as a filter medium in water purification, and then very minimal residential use for heating and cooking. South Africa has a production of roughly 3.5 million tons per annum. And generally, we have been a net exporter, as you can see on graph 6 on the side. But something then happened in the second quarter of 2022, which also affected what happens in the current quarter. And briefly, what happens here is that I believe due to the Russian war with Ukraine, Russia was not able to export this product to South Africa in the second quarter of 2022. And by the time the country returns to the market in South Africa in the second quarter of 2023, it then creates essentially a trend that looks like a surge, whereas it's essentially seemingly a return to normal trends. However, it is notable that even though Russia is a very large supplier of this product to South Africa, their exports generally tend to fluctuate, so they can be anywhere between 1 million kilograms to 100 and something million kilograms. And we saw that there was a base of 0 in the second quarter of 2022, and this then surges by more than 100 million kilograms to around 147 million kilograms in the current quarter, that should be 2022, quarter 2, 2023. And so it also, taking into consideration the fact that local anthracite production did increase in the first 2 quarters of 2023, it doesn't appear that there is a shortage of supply, and there seemingly is nothing else out there that would have been affecting the overall demand and supply. So this really just seems to be a return to the normal trend. And then lastly, this is just a look at some of the products that we've analyzed for the quarter and found that the surges in quantity do not necessarily match previous trends, but also do not match what's been happening, in terms of the rand value of those imports. And so we flag them as data errors, and we do share this with SARS, and hopefully they can let us know if we're correct or not. But generally, the issue here appears to be one of conversion from whatever the import source country is to however South Africa reports. So in most cases, those countries report as kilograms, whereas South Africa tends to report in cubic meters, especially for wood products. And so that's mainly the issue with the data errors. That is the end of my presentation. I know I said 10 minutes, but I think I'm over. I will take questions after the next presentation. Thanks.
Yes. Thank you so much, Nakwanda, for the presentation. So please, we only have 5 minutes left. So we're going to go straight into the export tracker, and I'm going to ask everyone to please just stay with us for 5 more minutes after 1, just so that Wendy can finish, and I'll also just take a question or 2 questions from the room, but all other questions online, please don't forget to post them in the chat. Wendy, over to you.
Thanks, Lesego. I'm literally gonna try and fly through this presentation. I'll skip a couple of slides for the sake of time, but I'll just like to acknowledge Rapula, who contributed to this quarter's publication. So the presentation was going to take the form of an introduction, the tracking method, overview of export performance, the composition of South Africa's top export sectors, South Africa's top export markets, and product selection. So what I'm going to do is just gloss over the first 3 slides, focus on the composition, the top export markets, and one product each for growth and decline. So this slide was just generally to give people a context of what the main policy documents say and have said for South Africa's export performance. And I think we're generally familiar with the National Development Plan, the New Growth Plan, and the plans that have been set to diversify and grow South Africa's exports, as well as see how we can grow some of our export markets as well. So for the export tracker, the objective is for us to provide a baseline of monitoring and tracking South Africa's export performance on a quarterly basis. And the aim of it is for us to produce up-to-date and accurate data on exports so that we contribute to policy formulation. Similar to import tracker, our data sources are SARS and ITC trade map. And in terms of data analysis, we look at export overviews in value terms at an aggregate level. And then for tracking purposes, we actually disaggregate it and evaluate it at a tariff line level. In terms of tracking method, we look at the top 100 export goods, but we also do extend it to 200 products so that there's variation in the product selection that we look at on every quarter. We look at year-on-year growth rates as well as the top products that are selected for further analysis. So in terms of overview of export performance, I think the REB as well as the import tracker highlighted our exports fell, and there was a moderation in imports, which then resulted in a trade surplus for the quarter. So in terms of composition of South Africa's top export sectors, we've seen over the quarters that the composition generally remains the same. Our top export products altogether accounted for 60% of South Africa's export values, and these comprise of precious stones, ores, mineral fuels and oils, vehicles, as well as iron ore. In terms of export products that experienced growth within the quarter, copper experienced quite significant growth, increasing by 64%. And this was mainly driven by growth in 2 specific products. That's copper refined and copper alloys, and the copper refined and copper anodes and electrolytes. And it was a very significant increase in demand from China. And this is linked to a lot of the infrastructure expansion in the electrical systems and construction sector. In terms of products that experienced a dip in the quarter, it was mainly inorganic chemicals, which fell by 44% from 9.4 billion in the same time last year to 5.2 billion in Q2 2023. And this was mainly due to subdued demand from the main market, which is Belgium. So in terms of top export markets, in Q2 2023, China remains the top export market for South Africa's exports, with exports to China amounting to 58.2 billion. And it saw quite a significant increase over the year, which is 25% increase from Q2 2022. And its share was 11.9% of South Africa's exports. So top export markets to China, export products to China comprise of ore, which takes the lion's share of 63%, and then it's iron and steel, 12%, copper, 7%, and fruit and nuts taking about 2%. So all of the top 5 products increased in the quarter, with mineral fuels and oil experiencing the highest increase of 140%. The USA was the second largest export market for South Africa, and it took a share of about 8% of total export value, and this amounted to 39 billion in the second quarter of 2023. Top export products also remain fairly the same over the quarters. It's precious stones taking 37%, vehicles taking 13%, industrial machinery 7%, aluminium 7%, and iron is still taking 5%. So amongst these top 5 products, vehicle experienced the highest growth, increasing by 24% from 3.9 billion to 5 billion in the quarter. Germany remains the third export market, accounting for 7.4% of South Africa's export value, coming up to a total of 36.5 billion, and it experienced a year-on-year growth of 15%. Also similarly, the composition of the top export products to Germany remained the same, with vehicles dominating at 48%, precious stones 17%, ores 12%. And amongst these top 5 products, we saw that chemical products increased by 45%, from 622 million in Q2 2022 to 903 million in Q2 2024. Vehicles saw a marginal increase and had been decreasing in the previous quarters. In terms of the regional export markets, the Asian market remains the top export market, regional export market for South Africa, taking a share of 33%, and the EU market taking 26%, and Africa taking 24%. Looking at Africa specifically, in Q2 2023, South Africa's exports to the rest of Africa increased by 5.1%. It was overtaken by the EU in this quarter after having overtaken it in the previous quarter. So total exports to the rest of the continent amounted to 127 billion, with top export markets in the region being accounting for 67% of South Africa's total exports. So when we take the data as is, we are seeing that Mozambique is dominating as South Africa's top export market, but I think Nokwanda highlighted on that it's mainly all minerals that are passing through, going to particularly, I think, the Asian countries. So when we factor in those commodities, removing chromium ore in concentrates, ferroalloys, coal and iron ore in concentrates, we see that Mozambique's share is actually dropping from 20.2% to 8.6%, making it the 5th largest market for South Africa. So Botswana, Zimbabwe, Namibia, and Zambia basically make up the top markets. And amongst those top 5 markets, Zimbabwe and Zambia experienced the highest growth, and it continues being driven by an increase in demand for cereals, that's your wheat and maize, and mineral fuel and oils, which grew by 108% and 56.4% respectively. Exports to Zambia were up by 22%, and this was driven by vehicles and industrial machineries. In terms of product selection in this quarter, 2 products were selected for growth, and those fell under the fruit and nuts, and that's mandarin and lemon and lime. I'll just present one since they're both seasonal fruits coming from the same product group and have similar patterns. And then in significant exports decline in Q2 2023, the product category is aluminium and soap, organic surface active agents. So I'll look at the surface active preparations because I think the ores and minerals have been presented in other presentations. So looking at growth in mandarin, I won't get into the details of what they are. I think we're all familiar. It's part of the citrus group, and their uses is usually in food and beverages. South Africa is the top global exporter of mandarins by both value and volume. That's amongst countries such as Turkey, Spain, and Australia. And what we see from the patterns on the graph here is that this is a seasonal product, with export volumes usually increasing in the 2nd and 3rd quarter, and then they decline in the 4th quarter. So over the years, we're seeing that although there's this seasonal pattern, there's been a an increasing trend over every seasonal increase. So SA's mandarin exports have shown a steady increase over the years during the peak season, with the highest export record observed in Q3 2022, with 325 kgs valued at 5 billion. So in Q2 2023, we saw that South Africa's mandarin exports grew by 38%, from 139 million kgs valued at 1.9 billion to 192 million kgs worth 3 billion in Q2 2023. The UK claimed a share of 21%. It was the top market of the export volumes, and followed by Netherlands, UAE, Russia, and the US taking those shares respectively. So all the top export markets for South Africa's mandarins have demonstrated an increase in demand. This is regardless of an 11% increase in the unit price from 13 Rand to 15 Rand 30. We're also seeing that exports to the UAE experienced the highest increase, growing by 57% from 11 million kgs worth 163 million to 18 million kgs worth 240 million in the quarter. A similar pattern can be seen with the lemon. It's also a seasonal fruit, and the markets are also similar, mainly the EU, UAE, and we've got Russia there. Sorry to rush you. I'm trying to really be considerate of the time that's left. I'll present this as the last slide. This was a decline in surface active preparations. So they're basically chemical formulations for cleaning surfaces and removing dirt, stains, and contaminants. South Africa is amongst the top 10 global exporters of this specific product, ranking 8th in both volume and value. So SA's exports of this product consistently averaged below the 20 million kg amount, and it eventually breaking the mark in Q1 2022, thereafter experiencing exponential growth, peaking at 108 million kgs, valued at 836 million in Q3 2022. So since then, exports have been declining with every subsequent quarter, as we can see from the bar graphs here. And South Africa's exports fell by just over half in Q2 2023, from a value of 38 million kgs valued at 684 million to 34 million kgs valued at 849 million in Q2 2023. So we're seeing that a lot of the surface reagents, the top markets are generally African countries, so markets within the SADC, and Mozambique emerged as the leading export market, accounting for 38% of the exports, followed by Botswana taking 16%, Zimbabwe 14%, and Namibia 13%. So the decline is primarily attributed to a significant drop in exports to Mozambique, which dropped by a significant amount of 72%, falling from 46 million kgs to 5.4 million kgs. We're not quite sure what drove this decline, but we've seen that exports to other countries remained relatively stable. I think, yeah, we can stop here for the presentation.
Thank you so much, Wendy, for the presentation. Okay, so it seems like we don't have any questions in the room, and I saw that Nokwanda responded to Fanie's question on lithium-ion batteries. So that's it for today. Thank you so much for being patient with us, and apologies for slightly going over time. I'd like to thank the presenters for coming and presenting on their work, as well as for DTIC colleagues, both online and in person, for attending. And now I'm going to hand over to Fanie for closing.
Thank you. From the DTIC side as well, thank you very much to TIPS. Thank you as well again to the audience for their participation. It's much appreciated. And then we'll see you all in the new year for another session again. Thank you so much.
Thank you. Thank you, everyone.